Hello, everyone. Welcome to our Quarterly Insights webinar for Q4 of 2023, Unlocking Economic and Renter Trends. I'm Brian Miller, Director of Partner Experience and Engagement, and I have the honor of serving as your host for today's program. This is our final Insights webinar of the year with our resident experts, Zillow's Chief Economist, Skylar Olson, and Senior Population Scientist, Manny Garcia. These webinars are designed to provide you with the latest trends, market analysis, and predictions to help inform your business decisions. Whether you're a property marketer, owner, or simply just interested in renters and the rental market, this webinar is packed with information that will empower you and help you stay ahead of the curve. First, you'll hear from Skylar, who is going to present the very latest from the rentals market, including some nearly real-time data she just wrapped from the end of last month. As mentioned, Skylar Olson is Zillow's chief economist. She was a foundational member of the Zillow Economic Research Department, where she leads a team of economists and analysts who provide unbiased data about the housing market to inform policymakers, journalists, academics, and consumers. Dr. Olson is often quoted in media outlets around the country, and we are so fortunate to have her here to unlock economic data for our partners. It's all yours, Skylar.
Hello, everybody, and thank you, Brian. All right, we are gathered here today to talk about the rental market, and we can even go above that and the economy in general and think, what the heck is happening? And at Zillow, we have an advantage when answering questions like that because we have an incredible data set. That data set is originally built on public records about all sorts of properties in our built environment, but it is enriched by housing professionals like you. Rental marketplaces in particular are ones that we, 10 years ago really could hardly see into at all. Zillow is different in a second way, right? My audience, as the chief economist at Zillow, my audience is not other massive econ shops, right? Though I will share my data with those, you better believe it. My audience is more often a real person who could use data about a marketplace that is previously opaque to make better decisions about how to, say, reach that renter at the right time of their life, or on the flip side, for that renter to strategically navigate a rental market and access, say, better affordability or a better lifestyle. You guys, as rental property managers or as building owners, enrich and turn on the lights with Zillow economists and data providers. And so let's jump in. Now, before I jump into the rental market itself, I want to tee up a question about the whole economy. Let's just ask, when will any market be normal again? The pandemic was a thing. And in response to the pandemic, we saw a lot of policy interventions, and we've experienced a lot over the course of the pandemic. Let's get pretty financial about what we experienced. On the left is a slide that talks about price growth relative to our wages. So we're going to jump into the rental market, but let's just stay really high level, okay? Now, that first year in the pandemic, we weren't doing very much of anything. If you see on that right-hand side, where you look at personal savings rates, not doing anything like buying lunches, or dinners, and lunches, going out to eat, vacations, led to excess savings. Okay, then we move forward in the pandemic. We've got a lot of excess growth coming because interest rates were really low for small businesses and home buyers and lots of things. Okay, there was also supply chain havoc that caused general price growth to be, insane, bigger than we have seen in decades. That's that gold guy that you see there, the consumer price index. Now, the personal consumption expenditure is just another way of talking about inflation that allows consumers to substitute between goods. So maybe you can avoid more of those price spikes. But even if I have a better, maybe less sensational price growth, that PCE, that blue guy, the personal consumption expenditures, still was growing faster than wages, that thing in black. Now, pay attention to the end, though. This is that good news, is that now wages are still growing steadily and price growth, general inflation, is slowing down. Here's why I had a bit more of a sigh to my voice than maybe even last time that we would have gathered together to talk about the economy. And that's that as we progress into our recovery from, say, really serious inflation, we are also starting to maybe experience more softness within households. And by softness, I just mean maybe more recessionary vibes, slowing down of economic activity. Check out that purple guy at the end. Our savings rates are kind of falling again, right? Even though price growth is slower than wages, right? So the household is actually starting to slow down a bit. Now, there's another thing. This is both mixed news. It's good news and bad news. We had been waiting as economists following the macroeconomy for this labor gap, the fact that there were so many more job openings than those unemployed willing and able to take them. We were waiting for that labor gap to shrink. Now, one of the reasons why the Fed kept saying higher for longer in interest rates, and everyone's been very worried about mortgage rates, is because that gap had seemed fairly sticky above 3 million. Now, the numbers that were released this month changed that picture a little bit. We saw job openings fall. We saw unemployed lift a little bit, and that gap did indeed start to shrink again. Now, this is great news for the inflation debate. It's great news for, say, mortgage rates to start coming down slowly, still not sensational news, but it is potentially bad news for, say, our household being less optimistic, right? Maybe a bit less willing to move after a new job, or maybe job growth itself is slowing down. Now, there is a lot of dynamics happening across the country as well that make some of those higher level numbers when we think about the economy kind of hide a lot of metro by metro dynamics, right? So what I'm looking at here is, or what I want to point out and notice you say is check out that gold guy, so information jobs. Think about your tech metros, your Seattles, your Denvers, right? Your Austins, were places where more and more tech growth had been happening. Of course, also Silicon Valley, San Francisco. Notice that information jobs had been kind of in a decline. That in some ways can kind of pass through into our rental markets, and we see more slowdowns in those areas as well. Notice as well that we're starting now, and why I'm mentioning more economic softness, to see a bit more softness in that manufacturing number. That shows us, when that sort of thing starts to happen, is generally a clue that the general economy is also starting to slow down a bit. Again, good news for that inflation debate, but also a reminder that our households need to be, confident and economically vital in order to, continue moving as readily as they had. Now, before I move on, this last wonky, I'm going to stay wonky in this general macro economy conversation for one last slide before we move to the rental market here. And this one is talking about inflation itself. So I was mentioning, hey, we're starting to see, some softness come, but that's all good towards this end. Okay, now what are we even looking at here? I showed you a couple of ways of talking about general inflation. Those are here. That gold guy is included here, the consumer price index. That's the headliner that we all see. The Fed, though, wants to look at core inflation. Core inflation in order to know where general prices are moving. Core meaning that kind of consistent stack that's going to drive us forward, as opposed to more random prices like food and gas. So let's say the food and gas, and we're going to get progressively more core and core. And you can see here that if I'm talking about this target pace, that's that dotted line, I still haven't come back to that target pace in those year-over-year numbers. And that's because in those past 12 months, price growth was still a little too strong. If I look at that lower level, I can see in month-over-month numbers, at least we're back down to that target, more in that current pace. September numbers were elevated again, but October looks good. Okay, the inflation debate is resolving and coming behind us. Now, there you don't get more core of core than when you get to shelter. So now we're talking a little bit more about our rental markets. This way, we're going to transition from how it informs on the macro debate and inflation. So here we're seeing our market rate asking rent index, Zillow's observed rent index that takes the listings on Zillow, looks at changes on individual listings to get at market pressure within asking rate rents. And here you can see the drama over the course of the pandemic. The blue guys behind it, these are your releases. So this is data from the census that surveys what's happening across the full rental market, not just asking rate rent for new movers, but those that signed, their old lease and stayed for a while. You can see for that sticking power of kind of elevated rent growth among that release market is still elevated. The fact that asking rents are slower than pre-pandemic is a good sign for the general inflation to keep coming down. You can see in that release market, there's still a bit more pressure. The pressure has come off quite a bit in that new asking rent rent. So let's move forward and actually get into that rental market, because that leading edge asking rate rental market is not only where, of course, we function, but it's a place where there's a lot of really exciting things happening, or at least a lot of change. And I know that can also mean often challenges for your businesses, but a lot of change going on can also mean that looking at data can help us readjust our strategies and understand to know how we have to be prepared. All right. So I mentioned before when talking about the inflation debate that we create something called the Zillow Observes Rent Index. That was looking at that monthly pace and how it's slowing down. I want to just make this much more crisp and simple. Look at just the level of it. Okay. We're not looking at month over month change. We're not looking at year over year. We're just looking at it. Look at rent and how it has grown over the course of the US. Again, this is asking rate rent. I'm showing you two of these guys. I'm showing you a seasonal number, and I'm showing you something that's been smooth. And that's because there's a lot of information in both of them. Now, in that smooth one, we're going to talk about trend, like where we're going from here. And then in that seasonal line, notice I pointed out a few kind of months, because pre-pandemic, we had a very typical and almost fixed seasonal pattern across the US rental market. Rent was the slowest and would possibly even be falling in October. This would be the opportunity for property managers to get their feet under them. So here we're looking at that month over month pace that reflects that previous graph. So you can see that on October, rents could potentially even fall over the course of October. Asking rate rents, right, can fall over the course of October. The biggest time that we're getting ready for during this season, for when you're really building up to your marketing campaigns, would come in April. This is going to be the biggest pressure on asking rate rents, where you're really meeting that market's fullest demand at that time. This is our time to get ready for that moment. I want to point out something though. Look at post-pandemic. A few things are going on. One, wow, the pace of, rent growth has been sensational. There's a lot of dynamics to follow. A couple things I want to point out though, in terms of seasonality, we're late when we go into the pandemic. I think a lot of that is just responding to a lot of the shock. So it's harder and harder to anticipate kind of the earlier trends and what's happening on that more recent data point. So for example, pre-pandemic, I never really would have expected rents to continue falling, or rather, I would expect rents to begin seasonally stabilizing in November. That slowest month would be October. Over the course of the pandemic, the slowest months have been more into the Novembers and Decembers, a little bit later for that season to start picking back up again. Now, how I might interpret what's happening without the seasonality, right? So I've maybe got a little bit more time. Things are still slowing down in the rental market, but I still, and a little bit more time even on that peak season than I did pre-pandemic. But if I'm thinking about trend, a few things are going on here, right? One, we're still noticing that pace of appreciation that's happening now is slower than pre-pandemic. Okay, we're talking about why in a second. That may be, ironing out a little bit early days to kind of tell whether or not that'll continue to come back up to that pre-pandemic pace, okay? And that's kind of what we're thinking about. How do we handle this moment right now, right? different metropolitan areas are going to be going through a lot of different things in a situation like this, where things are stabilizing and still slow and kind of maybe recovering, but we'll see. All right, so before I move on and talk about individual markets, I want to note that I just talked about asking rate rent. Asking rate rents, right? Setting that asking rate rent down, and then that sticks out through the whole year and then re-anchors the renter lower next time, right? If I was to drop that asking rate rent. So what do we do instead often is offer a rental concession, a temporary rent relief that wouldn't re-anchor that list price lower that next year, right? Okay, so we see a lot of use of this strategy, particularly right now. And notice we had seen rental concessions slow down as we saw asking rates, come flat. Now that we've starting to see asking rates, truly kind of flatten out here towards the end, what are we noticing? We're noticing those rental concessions increasing as this alternative strategy. And we're going to see that even more when we jump into individual metropolitan areas. All right. This is where the drama is too, because we as individual renters or as rental property managers or rental marketers don't operate. Well, some of us some very large rental marketers would operate at a national market. Most of us have to think about where our buildings are actually located, right? Where are our homes actually located? And here's where we see some really interesting dynamics. I want to point out a few things to you. Check out Tampa. Check out how Tampa and Seattle pre-pandemic in terms of how different their rent was, right? Tampa offered incredible affordability relative to a Seattle rental market. If you look at that projection forward, the rent asking rate rents that we have on Zillow, and again, this is an index where I'm just looking at the change in rents from month to month. So we're not looking at different units on Zillow. This is a rental index looking at that market rate pressure of asking rate rents due to a lot of migration to Tampa. Then look at how much they've come up towards each other. I also really like to look at Austin dynamics. You can see that's one of the few places where we have seen asking rate rent good and truly fall. Salt Lake City, on the other hand, you just see asking rate rent having plateaued in mid-2022 and having a hard time, moving from there. And yet, check out Columbus, Ohio, steady as she goes, almost over the whole course of the pandemic, a market that grows steadily, offers a bit more resiliency. Let's jump in and look at what that looks like. You can see some of those places set in. I'll point out something interesting to think about. Columbus, Ohio, that steady as she goes market is in the middle of the pack, even when I think about change in rents since the pandemic. I like to think, look at how much pressure has been on rent. If I'm thinking about the change in rent since the beginning of the pandemic to today, it's kind of like a meter on how appealing this rental market was over the course of the pandemic, that pressure on demand versus supply. So check out, for example, San Francisco that struggled, over the course of the pandemic. Move over Boise. We have Knoxville, Tennessee, incredible rent pressure. And then, of course, as I just pointed out earlier, that Tampa, and I didn't show that example, but Miami, right? Incredible rent growth. Check out that area around New York, right? Slower growth or, growth over the pandemic in New York itself, and then even in Boston. But that's to the advantage of Hartford, Connecticut, or Providence, Rhode Island, right? That become alternatives when people are moving about over the course of the pandemic and trying to find an option for affordability. I did not show these guys on that previous slide because they are such expensive markets. They don't look right. You can't see as much dynamics in more affordable ones, but these 4 high-flying, expensive markets across the country, you can see how much they change places. The one that I did want to point out to you was move over San Francisco, and New York Metro is back on top because of a lot of that struggle that the San Francisco Metro had over that time. Whereas the New York, this is the whole metro here, okay, not just Manhattan. And you can see you still saw a lot of rent recovery, especially in those outer boroughs. excuse me, not recovery, just full change. Well, when I see so much rent growth over the course of the pandemic, as an economist, that's of course bad for affordability, but it is a call to markets to respond. We saw units under construction grow like crazy, but the softness that we're seeing here is a lot because of those units actually completed. Now they're coming online, new apartment buildings are coming online. Now, what do I expect to happen in the future? This is pretty important for what I expect rent to do next. I don't expect rent, if it is recovering to that pre-pandemic pace, I don't expect it to keep going from there and have another period of time where we have a lot of pressure on rent, because we do have a lot of those units under construction, that pink guy. I don't expect us to suddenly complete more and more units because, we as, the supply side of this picture wouldn't want to dump a lot of the same kinds of units, the same kinds of buildings onto a market all at once. And so you might expect those units completed to just be steadily elevated from here. Keeping rent growth, you would think, a little bit less than pre-pandemic because of the elevated deliveries, but we've got a lot of renters out there. And so I wouldn't expect, again, as we saw from our numbers, rent is by no means falling these days, despite all of this new product. Let's bring me more to the now, because that was, since the course of the pandemic, it hides a lot of much more current dynamics. If I bring us more to the now, I can start to see places where rents have been correcting. San Francisco really, struggled throughout the full course of the pandemic. And remember, those information and tech jobs that we mentioned earlier continues. Rent growth continues to struggle in that major metropolitan area. Same with your Austins. I can look across this picture and you can start seeing that Midwestern strength, right? That pops out at you just right away in terms of rent growth. But I'm looking at year to year. So that's just how rent compares to last year. Let me bring it even more to the now to think about how things might be changing. Here is my quarter over quarter growth. So a little bit more recent trends. You see still heat in that Columbus, right? And in a lot of the Midwest area, that's persisting even to more recent trends. You see more negative numbers though start to pop out. We did not, in the year over year map, we did not yet see that rent softness coming forth in the South. Now we're starting to see a bit more of that softness come forward, potentially with more of those deliveries coming online. Now, that was asking rate rents. And remember, we have another alternative. We have a short-term rent break, right? Or a rental concession. Here, I just wanted to point out a couple of examples. Now, I'm going to use rental concession as to talk about it as an alternative, right? So think about Salt Lake City and how we talked about Zori. The asking rate rents had been flat for almost a year. Salt Lake City is one of the markets that had such a stunning, or maybe the highest, fastest growth in rental concessions as an alternative, right? Instead of dropping asking rate rents, Salt Lake City much more often saw an elevated amount of rental concessions. Let's talk about Columbus, Ohio. We mentioned how there was a lot of rent strength, rent growth still, even in the more recent quarter-over-quarter numbers in Columbus, Ohio, in the greater Midwestern region. And yet, when I look here, I notice that Columbus, Ohio has a faster increase to rental concessions over the past year than, say, that blue, the US. And in fact, when I click forward, I see in this bar chart that among the major metropolitan areas where we can estimate the share of listings with rental concessions, Columbus, Ohio is actually among the metropolitan areas on the left here, with among the largest surges in rental concessions. So still strong rent growth in some respect, but rising early indicators that asking rate rent either can't be sustained, or there is definite product that is maybe much softer in terms of its demand, or who are experiencing a lot of deliveries in competition with other supply, where they're having to make compensations to get that renter in the door. On the flip side, look all the way on the other end of this bar bar chart and you see the areas where the listings don't have as many rental concessions. I mentioned two places where even our asking rate rent was growing, maybe in favor of nearby more expensive metros. So that was your Hartford, Connecticut, and your Providence, Rhode Island, sandwiched in between your New York and your Boston. And check out there that stronger rent growth as well as a drop in rental concessions, as potentially the renter moves about and tries to handle some challenges to rent that could have occurred if they moved over this past year to get these higher asking rents. All right. Now, since rent has slowed down, the upstream supply also slows down, right? If the rent growth was a call to start production, the slower rent now and starting to see more of those negative numbers is certainly a call to slow down. Here we're seeing multifamily housing starts, so units started. You can see that they've dropped back to pre-pandemic levels in terms of that pace of production. So starts didn't drop way below, but back to that pre-pandemic pace. You can see some small signs of maybe, but I would expect it to remain down from here. Remember, we have a lot of apartments under construction, and they're going to try and slow that down as we are experiencing softer rents from possibly so many deliveries of a similar product or quality. Go even more upstream to permits. So not just how many units were started, but how many units were authorized during the course of that month. You can see there that we don't yet have this little sign of plateau yet. So permits are probably still on their way down here in that multifamily, so 5+ unit space. But you can see those single family units have kind of since recovered from a huge floor here with mortgage rates surging back up. That recovery is in huge part to lower new listings in the existing home market. And so builders are, I think really still being called forward for that single family product, especially with what I'll talk about at the end. Now, with rent growing and, having grown, over the course of the pandemic and now softening, the rent affordability picture is changing. I previously had been, very used to talking a lot about this number getting just radically worse over the course of the pandemic. Now that wages are continuing and rent growth is slower than pre-pandemic, and we did go through a period of time where rent growth did near zero in a seasonally adjusted way, or asking rate rent, you can see this picture is getting a little bit better. Now, there are two lines here. That golder red line reflects what it would cost to rent the typical rental unit, right, out of the median household income. What share would be needed? That blue guy is, that's going to be more relevant towards the end when we think about how much more expensive it is to rent the kind of unit that you would be more likely to buy. So much more likely to be a single family unit or a higher quality, or where they're located, right? And you can see those pictures. Either way, it's improving on that rental side of that picture. Now, rental affordability is improving. That does kind of an interesting thing, right? So rent affordability was at its worst last year. For example, renters last year could experience some of the worst rental affordability of anyone who has moved, right? 61% of renters say they're considering moving within the next 3 years, but it goes up if they're recent renters. The way an economist often tends to think about this is a recent renter could have experienced those higher market rate prices and be more motivated to move, because we have other questions that tap into the renter and why they move to say they are more likely to move the more they've experienced a rent increase in that previous year. Stay tuned for Manny Garcias to jump into our survey data about the renter later to unlock some more questions there. But as I start to see that affordability picture change, that actually can bode well for more renters leaving kind of their current apartments and trying out the rental market again, because asking rate rents are softer. Now, I might also want to pop out from an existing landlord, especially one that might, where I might have seen a large rent increase, and move far away. The affordability picture is very, very different depending on where you are across the country. I want to point out that when we saw that fast rent growth, it almost reflected this a little bit, right? We saw the Midwest, a place that offers more affordability, rent growth more persistently strong, whereas rent was much slower in markets where affordability is a greater and greater challenge. Particularly say, it's obviously it's not, there are, this is not totally, that's the joke about, I make a joke now about the world would make a lot more sense if it wasn't for Florida, because Florida, some of the most expensive markets are in that state, and yet we did continue to see rent growth. So there are exceptions to this rule for sure in terms of where we see that growth. And yet on net, affordable markets could tend to pull people in, and you may have an easier time filling in more deliveries. And there are a lot of people to pull in. I know I have showed this graph before, but I like to remind us because this is the demand side of the picture in housing. The economy is getting a bit softer, right? Hopefully we're still, knock on wood, that we're expecting a softer landing and we will avoid a recession and go through just a period of softer economic growth. Underneath all of that are real people that just exist, whether or not the economy is booming or dragging on. This is more and more the demand behind housing, right? Fundamental demand for us relative to other markets is the people here, the fundamentals. We fundamentally have a massive generation right now between the median age of moving out and the median age of first-time home buying, which means the US population is bearing down on US rental markets as we speak. And at that same token, those boomers are starting to head into older ages, are possibly becoming single again as they lose a partner and considering rentals again for the first time in their lives. And that is a massive, massive generation and dynamic that'll continue to happen over the next 5 and 10 years. Now, there's going to be more dynamics that happen over the next 5 and 10 years. There are a lot of changes that came over the course of the pandemic, and not all of those changes may be undone. One of those big changes, though this could evolve over time, we just don't have as many reasons to see how home prices will be able to fall dramatically because the supply picture in the for-sale space is just a bit behind, right? And the economy is recovering. So the barriers to become a homeowner, right, such as saving up for that down payment and those large upfront costs, are kind of bigger than ever. Well, not ever. In fact, they've gotten a little bit better. This is a slide that I call years to save. I also call this slide, it's not the avocado toast. What we're looking at here is how long would it take you to save up for that down payment, to get from the rental market into, say, become a new homeowner without, being able to sell a previous home. You got to do it possibly by yourself if you don't have the bank of mom and dad. If you were to save up 5% of the median household income every month, it would take you 8.7 years to save up for the typical home, 10% down on the typical home these days. Whereas back when boomers were doing it, it would take you roughly only 5 or 5.5 years for previous generations. So it is harder, even at the same savings rate, to become a homeowner. Now, you've seen that's gotten a little bit better as wages have continued to rise and home values are flat or close to flat at this time as well. But this affordability picture is not improving very dramatically. Our forecasts do not have this improving very dramatic in years to come. If anything, we might expect it to stay around 9 years. It gets even more crazy when I take you to the monthly payment. So let's say you did save up for that down payment, took you a long time to do it. Would you want to move on and become a new homeowner? Well, there's lots of pieces in this puzzle. First up is your monthly affordability. Pre-pandemic, you would have saved around $400 to become a new homeowner, to lock in a 30-year fixed rate mortgage at prevailing rates and home prices back then. Today, if you were to become a new homeowner, you'd probably lose $200 relative to renting even the similar kind of home that you would buy. Remember previously in our presentation, there was those two rent affordability numbers. I'm talking about the bigger one, okay? So a new homeowner would be less likely to afford the same unit than a new renter, even at today's asking rate rents. This matters for a lot of people on a monthly basis. It's not the full rent versus buy picture, but it is certainly a big one. People will be renting for longer and further in their lives because to avoid this kind of level, you have to save up a larger down payment, right? And avoid this kind of higher and elevated monthly payment. Now, should you do that, there are still lots of advantages to getting a mortgage that accrue over time. Right? You get a 30-year fixed rate mortgage, you avoid future rent increases. And we do expect rent growth to return, say, to that pre-pandemic regular pace. A mortgage provides you leverage. You only saved up 10% down, but you got the appreciation on the whole asset. Only rich folks, really, really affluent folks, do leveraged investments in stock markets. And yet here we have that advantage for real estate for an everyday household. Then there's forced savings. If you hold on to that mortgage for a long time, eventually a lot of those payments will start paying down principal. That's a bit of a behavioral advantage to make sure you're saving every month. And then tax benefits in the US are huge when home buying. All these things can make it worth it to become a new homeowner today, but only for folks that want to stay longer than ever. You know, over the course of the pandemic, if you got a rate below 3%, you could have broken even with huge upfront transaction costs relative to renting and investing in some, regular like high yield cash account or very mildly, in stock accounts. Gosh, in a matter of a year, which is fairly insane, okay? Much more normal, right? With interest rates kind of back out of crisis pricing, no longer near 3%, now up near 7% is what this simulation has. Now with home values forecasted to grow slowly, the forecast behind this number right here is only around 2.25% over the first year. With home values growing more slowly and with mortgage rates elevated where they are, it is a financial advantage to buy a home, even if the renter gets guaranteed 6% on what they earn with that down payment in stock markets instead, so long as you stay for 7 years. Now, the typical homeowner stays for 13 years, so that could be worth it, but that includes a lot of older homeowners. Folks in the earlier stages of their lives might not be sure they can stay for this period of time in their next home. Now, if home values are flat or we get more pessimistic about that pace, it could take us up to 10 years to break even relative to renting and getting a 6% guaranteed rate of return somewhere else in some other asset instead. That's going to keep people in rental markets even for longer. But it is important to mention that your typical American household, if they are not familiar with stocks, might not even be able to get a 6%, risk-free rate. It might be something much more like 2%, in which case the advantages of buying a home become a little more real again, right? You break even in only 5 years. Regardless, buying a home is not like it was in the pandemic, where it was practically like winning the lottery or get rich quick scheme, okay? Buying a home is back to being what it was before the 2000s, right? A long run steady investment made when you're in a secure long run time in your life, something that's happening later and later and later in life for so many more of our households. What does that mean? That means the renter will be older than they used to be. A typical renter who hadn't moved within the last year in 2019 was in their 30s. Now, a renter who didn't move last year is now in their early 40s. Okay, we rent for longer. We rent at different stages. For the single family rental marketers, right? We now rent for different lifestyles. Rental markets are changing. Our renter is changing, and they're changing as well because of the barriers to move on to that next stage. Big picture is our renters have more questions than ever as they face possibly more barriers and even more options. Different metropolitan areas, new units. There are a lot of things that we can do to help. And there's a lot of data that we have on hand to support you. Check us out at Zillow.com/research. And back to you, Brian.
Thanks, Skylar. Next, you'll hear from Manny Garcia, Zillow's senior population scientist. Manny joined Zillow in October of 2018 to work on Zillow's flagship Consumer Housing Trends Report and over 10 other renter and buyer surveys. Today, Manny will again dig into some more findings from our newly released 2024 Rentals Consumer Housing Trends Report. With data collected from a nationally representative survey of over 21,000 renters, this report provides an invaluable snapshot of their preferences and behaviors. You'll also be able to grab a QR code so you can download the full report for yourselves. Manny, the floor is yours.
Thanks, Brian. My name's Manny Garcia, and today I'm excited to walk you through some of the key findings from our 2024 Rentals Consumer Housing Trends Report. At the end of the session, I'll also give you a QR code where you can download the full report to share with yourself and your teams. I'll give a bit of background on the report, how we get our data, an overview of some of the big shifts that we're seeing, and finally, some final thoughts on how these findings can impact your business. So let's talk about the methodology behind the report, how we collect our data, and what gets represented. For this year's report, our team conducted a nationally representative survey of more than 21,000 US renters. That's almost 3 times the sample size of last year's survey. We defined renters as household decision makers ages 18 and up that rent their primary residence. The study was fielded between April and July of 2023. And when it comes to our participants, we recruit and weight our sample to accurately represent the true population of US renters. Whenever possible, we included survey questions from previous years, which allows us to measure year-over-year trends in some key categories. We asked renters about the type of rental home they were searching for, as well as the type they ended up renting. And we see that most, about 60%, are looking for an apartment, with roughly similar counts searching for units in small, medium, and large buildings. And then a little over a third said they were looking for a single-family detached house. And then on this slide, we get more detail about where renters actually end up living. On the top, we see the type of home that renters originally hoped to rent: apartment in small building, medium building, and so on. And then on the left, we see the type of home they ultimately ended up renting. We see that overall, most renters ended up in the type of home they initially wanted. 67% of renters searching for a unit in a small building, for example, found a unit in a small building. For renters looking for a unit in a large building, the percentage was higher at 76%. Same with renters looking for a single-family detached house, again, 76%. This shows that renters have some flexibility in the type of home they end up renting, but generally stick close to their original search preference. When it comes to how renters are searching, we see some strong trends. We're seeing the highest use of mobile websites, either on a phone or tablet, and an increase over time in the use of apps. While over that same time, we're seeing the use of websites via laptop or desktop computers trending downward. That tells us it's more important than ever to consider how your listings are appearing on a prospect's phone. So we know how they're searching online. We also know what they're seeing, and especially important is that renters are increasingly choosing online. The number of renters who choose a home without taking a tour at all has remained fairly steady since at least 2018. Right now, around 1 in 5. That includes both pre- and post-pandemic. Where we see some significant trends are the number of renters who are taking fewer tours overall. 74% are now taking somewhere between 1 and 4 tours, with the largest share taking only 1. While the number of renters who took 5 or more tours has been shrinking over time. So that's 19% of your audience renting sight unseen, and many taking fewer in-person tours than ever before. We also see more renters who want to move away from applying in person. In 2023, we saw nearly 2/3 of renters report they'd prefer to apply online, part of an upward trend that's continued over time. And it should come as no surprise then that we see that renters increasingly want to sign their leases online. 51% of renters reported online as their preference. We are seeing that their options to sign online have also increased over time, nearly doubling since 2018. But there's still a gap between those who want to sign a digital lease and those who can. And last, paying rent. We've stayed pretty steady on this point over the last few years. Nearly 70% of renters would ideally pay rent online. Just like with leases, we're seeing their virtual options increase, but the gap still persists. So now let's talk about the mobility of your renters. About 1 in 5 currently wants to move. Another 22% are considering a move in the next year. Added together, 61% of renters said they're considering moving within the next 3 years. Only 24% of renters reported no plans to move. Renters who moved in the past year are the most likely to report plans to move again. For example, we see that recent renters with a higher rate of considering moving, 25% versus 22%, and higher still for those considering moving in the next year, 29% versus 22%. Put another way, you may expect to work the hardest to keep the renters that you most recently recruited to move in. So if they're looking to move, where are they planning to go? We see roughly half plan to continue renting, but a significant chunk, 43%, are looking to buy their next home. What do we know about their typical lease terms? This is the type of lease they're signing, the duration. 12 months was reported as the most common lease duration. 20% have longer leases. Nearly 1 in 4 say that they are month to month. We know that these leases are least likely to terminate during the holiday winter months. If we assume a 12-month lease, which we saw as most common, that means the largest share of leases are being signed in April, June, and August. And you can see each of those peaking on this graph at 10%. So, applying. Now, while we discussed earlier, the number of in-person tours are down, we're actually see the number of applications going in the opposite direction. That's up, possibly in part because renters are increasingly able to submit online. On the right, in the dark blue, we see that 57% of renters in 2022 submitted 2 or more applications, while 32% submitted only 1. In 2023, we see this 2 or more number jump nearly 10 points, while the 1 application number also dropped by over 10. This is part of a longer-term trend. Here we see the number of renters who submitted 1 application is gradually going down over time, with one of its biggest declines between 2022 and 2023. Meanwhile, we see the 2 or more numbers trending upward, up 16 points since we started measuring in 2018. When it comes to cost, renters report their typical application fee was about $50, but that's not being paid equally among all renters. Younger renters are much more likely to report paying a fee, somewhere around 90%, while only 72% of renters age 60 or older needed to pay one. We also see the rate for these applications trends to go down as renters age. Application fees are the norm for renters in all building types, but they're near universal among those in large, 50-unit or more multifamily buildings. 97% of multifamily renters report submitting at least 1 application, and 95% report paying an application fee as part of securing their rental. And then along with application fees, renters often need to pay security deposits. Most renters, 87%, reported paying one, with the amount ranging between $500 and just under $1,000. As with application fees, we see that these deposits aren't standard across all ages. Generally, younger renters like Gen Z and millennials have the highest rates, and these go down once a renter is age 60 or older. The good news is that most renters reported getting at least some of their security deposit back, about 2/3, while 42% reported getting back their entire deposit. The common topics of contention between the renter and their property manager or landlord were repair responsibilities, utility balances, and other types of move-out costs. So let's zoom back out and quickly review what we've learned. We see that most renters tend to start the process knowing what type of home they want to rent, and the majority are looking for apartments. Those most likely to land in the home of their choice were renters looking for apartments in big multifamily buildings or those looking for a single-family detached house. We also continue to see renter demand for digital tools. More renters are shopping online, touring virtually, and visiting fewer properties in person. They also want to be able to apply, sign, and pay their rent online. And it's more important than ever to prioritize your mobile site and app presence. Renters who moved in the last year reported being the most likely to be considering moving again. Only 15% of these recent renters report no plans to move from their current unit. That makes it essential to think about how you can promote loyalty or value to your existing renters. We also know it's expensive to move. Renters are applying to 2 or more properties, often paying $50 per application, and at least another $500 in security deposits. Help them avoid surprises by helping them understand all of these expenses upfront and establish clear expectations to avoid disagreements at the end with move out. So that's it for me on renter insights. But it's not it for the report. We've got a lot more information in the full Rentals Consumer Housing Trends report. Scan the QR code here to download a free copy for yourself or your team. We also have a lot more data available anytime from our full research team at Zillow. You can find it at zillow.com/research. Thank you so much for your time, and I'll send it back to you, Brian.
Thanks, Manny. I encourage everyone to take advantage of that free report and Zillow's other data resources. Well, I hope you enjoyed our final webinar of the year and you're feeling more informed as you move forward into the new year. Be sure to stay tuned for an invite for our next webinar in Q1 of 2024. Thanks again for joining us. We'll see you real soon.